Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Here we are with another episode of Black and White Market Minute on Life Planning 101. Matt Ervin and Aaron Kennedy with you today on this. It's wonderful, I guess, end of month, end of quarter Friday. Kind of a weird day, I guess. There's a lot going on.
Yeah.
Fed's trying to shut down. The market's being volatile, and the Fed is, with interest rates, that's a whole other gamut. But Aaron, let's start with the shutdown.
Yeah,
Tell me, what the heck's going to happen there?
Lots going on with the market. The market's not really happy about any of it. But the shutdown, it looks like that's going to happen.
Yep.
I think this is just an attention ploy, to tell you the truth. I was speaking with somebody earlier, and if the government actually does shut down, they're basically losing their own jobs.
Right.
Yeah, and if we default on any kind of debt, there goes the U.S. dollar.
Right.
I mean, this could be catastrophic. Could be, but I mean, would they really?
No.
Come on. They do this every year.
It's sometimes multiple times, right?
Yes.
It doesn't seem like very long ago we were having the same conversation. I think what it all comes down to, it's not the actual shutdown. It's like they're going to allow the government to shut down, and it's the non-essentials that kind of go away. It's the number keepers, right? The accountants, the economists, things like that. They're going to get a few day vacation. They're probably going to get back pay, but it's really the political ploy of what can you attach to that bill to get it across the floor.
Somebody wants more money in their pocket, and they're going to throw a tantrum until they get it.
They get it,
and they're going to threaten the U.S. people, and This is the game.
Modern day warfare is politics, right?
Politics. Until they get their money, they're gonna put all of us in jeopardy.
Right.
And they know that. It is a game. This isn't the first time or the fifth or the 10th or this is what we do every year.
Or the last.
Yeah.
Right? Yeah. So not overly concerning. I think the market hates uncertainty. We pretty well decided that. And so that's the uncertainty coming. But this week was pretty volatile. What the heck happened there?
Yeah, interest rates have been on a tear. We touched on this on our last podcast, but I think the market finally is starting to believe Jerome, and the interest rates are moving
big time.
The longer end, the 10-year yield, just in the last 5 days, jumped about 10%.
Wow, that's big.
And, 48, almost 48 bips, and that's a big move.
In the
guys.
bond world, that's huge, right?
Yeah, that is huge. We do not see this kind of stuff. We're back on the 10-year. We're back to the yields of 16 years ago. Yeah. Think about that. That's how much we've moved. And, if you go out even longer than that, it's at a 10-year high. If you look at the 30-year. Yeah. So we had big movements, and the market reacted like it should have.
Well, and you always hear the 2-10 spread, right? The inverted yield curve means recession. We talked last time that it usually, I guess, not reinverts, but reverts.
Fixes itself before the big.
Okay. So I'm not saying that we're fixed but we're headed closer to that way than we were a week ago.
Right.
But it was over 100 basis points or over 1% spread. And now we've cut that in half.
Yeah. Yeah, we're back down to a little bit under 0.5%.
Yeah.
And it's good.
Yeah.
The market should be believing, and we've said it so many times how confusing of a market this is. Good news is bad for the market, bad news is good for the market. Come on.
All right.
Leave me alone.
That's right. This is what we've been anticipating, right?
Yes.
So this is, this helps tell our story where we've missed out on some of the upside this year, trying to anticipate some of this uncertainty coming, and it's here. And I don't think you can ever be perfectly positioned. I'd like to think you could,
right.
But you just have to do the best you can to be logical and mindful and a steward of capital. And but this is the moves that we've done up till now have really helped us out this week. Would you say that?
Oh yeah, absolutely.
Okay.
Ever since about July, and we've made our changes. We've been on the positive end on the not only market volatility but returns, and it's really seeming to pay out a lot more. And you just think, if you go look at all these sectors out there, they're almost all red or flat. If that webinar hadn't happened about ChatGPT, we would be almost done with our correction.
Right.
Just think.
Yeah.
One news print pushed 7 companies through the roof, and it looks like the market's doing great.
Right.
The rest of us are not.
Right. Well, that's right. And oil is super inflated, but even some of those companies still aren't overperforming.
No. Oil's a different animal.
Right.
There's two sides of the trade. One is demand. If we go through a recession, nobody's working. Walmart's not getting as many goods. No more trucking. Oil usually goes down with economic recessions. But we got to balance that with, do we even have any oil?
Right.
We're not drilling. We're not investing.
That's the anticipation. They're not necessarily doing it to inflate the price. That's a secondary reaction. What they're doing is slowing down production in anticipation for more recessionary times, because they don't want to be sitting on a bunch of oil. Because again, go back to the coconut store we used to tell, if all of a sudden I have a basket full of coconuts and no buyers, they're not worth anything.
They're not worth a thing. We saw that COVID.
Right.
Negative oil.
Yeah, they're not going back to that.
No.
That's good.
But I'm bullish on oil, and that's specifically from the supply side. And, if we get a hiccup from a recession, that's going to be a good place to be.
That's right. So one of the points you made before we got started today is really with the Fed moving interest rates. You said you were listening to a certain gentleman talk this morning, but, the government basically hurting themselves. Tell me more about that.
Yeah, I thought it was pretty fascinating. The whole message was most companies are okay. Most everybody has their debt the way they need it to be, other than the consumer. But the government is really what's getting hurt the most with these increases in interest rates. And our government has a big time spending problem. And it does not matter how much.
You might say that a little louder for those in the back who didn't hear you.
Little bit of a spending problem. So it really doesn't matter how much we increase interest rates if the Fed or the government is just turning around and spending like crazy. And we're talking trillions of dollars that we don't need to spend. So it's a double-edged sword here. So I think the message this morning was maybe Jerome is increasing interest rates to get the government to stop spending.
Right, because at a certain point, again, supply and demand, you saw, even when we saw interest rates fairly low or they were starting to creep up, everybody went out to refinance before they got bad. Well, the mortgage market broke because demand was so high, right? So flash forward, if the government's still going to spend no matter what, there's a certain spot that they'll stop. But think about this.
They won't stop.
Well,
the market will
force
them to stop.
Yeah, and that's right. And really, because when you see business owners they got their company risk right when interest rates got out of control. You saw a lot of company debt paid off. Even look at people like Apple that financed a bunch of bonds. They're just sitting on the cash. For nothing. Because they were stewards of their own capital, right? Because they were writing their own checks out of their own checkbook. But the politicians are writing checks out of your account and my account and the American people account. And you usually spend other people's money a little differently than you spend your own.
Yeah. Just do the math real quick. What is 5.5% of 1.7 trillion?
It's a lot of zeros there.
It's a lot of zeros. Man. Anyways, just what we've done this year would have crippled our economy 30 years ago. Yeah. Think about that. Yeah. 1.7 trillion in debt in 1 year, and nothing's really. I mean, we're not in a recession. We're not in a war.
Nobody's wavering.
Right? It's.
Yeah.
Spend until it breaks.
Yeah, and it's going to be interesting because the Fed says they're so data dependent, and if this interest rates is forcing us into a shutdown and they can't have the data, we're kind of in the blind spot. So, again, a little bit of uncertainty, or a lot bit in a sense, but staying disciplined in what we've been doing is going to really help us through this time. I mean, it's all going to work out. It always does, always has, and it always will. Right? We've got to have that hope and that faith that that'll happen. Yeah. So
time is our friend.
That's
right. You just got to be able to strike and protect what you got.
Mm-hmm. And having that capital and earning that interest rate right now is pretty damn good. So
there's nothing wrong with 5.5% right now, and just kind of sitting around and waiting.
That's right. So, Aaron, before we get wrapped up today, any last minute thoughts about the market or anything going on that we didn't touch that you want to share with our listeners today?
I don't think so. All this volatility, it's all interest rates. It's not really company specific. It's not that the world is falling apart. It's no fun when the market starts to drop, but it's just a function of interest rates. And we'll eventually get through this, and the strongest companies will survive.
That's how it's been. So that's great. Well, thank you today, Aaron. We'll wrap up today's episode of Black and White Market Chatter on Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.